Howdy, welcome back to Dion Talk. In this video, I'm going to talk about how much money I save for capital expenditures, repairs, and vacancy. This is a question that I see come up in the forums a lot, and it seems like it would be a pretty simple question to answer. But this is a moving target. A lot of us found out in 2020 that a pandemic or something can come out of nowhere that we weren't expecting, and how much we have saved could be very different based on how you've built your portfolio. I made this video covering ways to protect your assets just in case there's something like a stock market crash, a pandemic, or a prolonged government shutdown. There are some simple strategies that I've used to help make it not as important how much money I had in reserves. That doesn't mean that reserves aren't important. I've just been able to use some simple strategies to make it to where I've never really had to tap into my reserves. While reserves are there to protect your assets when things go wrong, it is your job to structure your investments around protecting your reserves, because they are for emergencies. It's important to diversify your tenant base. I like to go with about 1/3 military, 1/3 Section 8, and 1/3 retired or working. That way, if one of the big major things happens, only about 1/3 of my properties are going to be impacted. And there are ways to do this legally. You can't run an ad saying, only military apply or only Section 8 apply, but I can advertise on base, I can advertise with the housing authority, I can tailor my advertising to find the type of tenant that I want, and then screen exactly the same and just try to keep those percentages where I want them. Then for me, it's important to diversify my property locations. I wouldn't want all of my properties close together so that they're pulling tenants from the same source. So if a port or a base or a big company closes down or moves away, I don't lose all of my tenants at the same time. So hopefully now you're understanding that it is your job to protect your reserves and your reserves' job to protect your assets. And the actual amount that you're going to need in reserves is going to depend largely on the size of your portfolio. How much you make at your job is also a factor. A lot of the people that I talk to that have rental properties base the amount of their reserves on either one of two factors. The first one is the value of their portfolio. They actually go off of a percentage, either 1, 2, or 5% of the total value that they want to keep in reserves. The other factor is some people go off of gross rents. However much rents you have coming in, you want to set aside a certain percentage of that to build your reserves. It seems like people are capable of making anything more complicated than it needs to be. If you're happy and you know it, overthink. If you're happy and you know it, overthink. That's just embarrassing. I need to edit that out in post. If you're familiar with any of my content, you'll understand that I love the KISS principle, keep it simple. And if it's your first time on my channel, you'll have to understand that the reason my strategy works for me is because I'm incredibly lazy. And the easier I make it for myself to do something, the more likely I am to follow through. So when first starting out, instead of thinking about a percentage of my total value or a percentage of my gross rents, I just picked a nice round number of $10,000. When I had 7 units or less, I kept a reserve of $10,000. To me, this meant that I can handle a few months without a rent payment, and I can handle replacing a roof or some of the emergencies that can come up when I only had a few properties to handle. But now, with a portfolio of 14 units, I've raised my reserves from $10,000 to $30,000. This is enough for me to feel comfortable that I can handle pretty much any emergency that comes up, and I can handle a few months if people weren't paying and I had to cover the mortgages myself. Even though I reached financial independence and all of my living expenses are being covered by the income produced by my assets, I'm still working. I'm one of those really lucky people that's worked their way into a job that I really love to have. So while I'm working, this $30,000 in a reserve account is something I'm comfortable with. If at some point in the future I ever find myself not working, I'm probably going to raise that from 30 to 50 if I haven't raised it between now and then because my portfolio grew. What I'm trying to say is that when you're first starting out, don't let the amount that you're going to keep in reserves be some confusing equation that becomes a barrier to you investing. It can be really simple. Pick a round number and go with that. That doesn't mean that when I'm buying an investment property, I'm not considering how much I set aside for reserves, capex, and vacancy. When I'm looking at a property and running the numbers to see if the math works, I factor 10% of gross rents towards repairs, maintenance, and capex, and 5% towards vacancy. Since I self-manage, I don't set aside any money for property management. So someday I'm going to debate whether it's a good thing to have a property manager or self-manage. But not today. For now, I choose to self-manage. The reason I don't factor in an amount for property management is because of the way rental property income works. When I purchase a property now, In several years, the mortgages will stay the same or possibly be less if I refinance to a lower percentage, but the rents will have a chance to go up. That's where I figured the money for a property manager would come several years from now when I finally get to the point where I decide I want one. Because I factored 10% for repairs, capex, and maintenance, and 5% for vacancy, even though I've never had a vacancy, and my longest flip took 4 days to turn the tenants over, so it was like a mad rush to get everything done to make the place ready for the next tenant. And that one turnover only happened because the previous tenant inherited a house. If I ever have to dip into my reserves, I have a total of 15% of gross rents planned to be used to refill that account. When the account is full, it kind of makes you think that I have an extra 15% of gross rents to spend. That's not true. I have an extra 15% of gross rents to invest. Every penny above that 10,000 when I had 7 units or 30,000 where I'm at now, every penny above that needs to be put to work to make me more money. And as you grow your portfolio, the way that I did, you're going to want to scale the amount of money you keep in your reserves as your portfolio grows. Because we all know, more money, more problems. Murphy's Law is that if something can go wrong, it probably will. The fourth corollary of Murphy's Law is that if a set of things can go wrong, they will, and in the worst possible order. So as you have more properties and more tenants to take care of, you're going to want to have more money in that reserve account so that when something does go wrong, and it will, it isn't going to sink you. There's another thing that can affect the amount of reserves that you might need to have, and that is your lender. Lenders have different requirements because all lenders are not made the same. So ask the ones that you're working with how much reserves they require you to keep. I work with one lender that said 10,000 at 7 or less, or 30,000 where I'm at now is totally fine. I have another one that said, what is the actual calculated value of your portfolio? We need you to have 4% of that in reserves. But reserves required to qualify for a loan are different than the reserves I like to keep in cash. Lenders will also recognize 50% of a retirement account as a reserve when you're trying to qualify for a loan. But I don't consider money in a retirement account as an actual reserve because I wouldn't want to pay the penalty and the taxes on the money that's locked away if I had an actual emergency. And there have been times where on purpose I drop my reserves way below what I actually want to keep in there. But I have backup plans. And I talked about this on my BiggerPockets episode 448, where when I purchased my fourplex, which was a house hack, I dropped all the way down to $200 in cash in my account. But I had $17,000 in untapped credit cards, I had money in a retirement account, and I had a paid off property. So I had contingencies in case things went worse. But I knew that I had income from a job, and I knew that I had rental income coming from tenants. And I was going to get the rents from the fourplex that I was buying with a gap month where I didn't have to pay the mortgage. So there are some times where we, as investors, feel like we're taking some risks that we wouldn't normally take. But the income snowball is a real thing. And within a couple of months, I had recovered to where I had the money in the savings account that I wanted to keep for reserves. I am definitely not saying drop down to where you have $200 in your account. But once you have your systems in place and you have a reasonably confident expectation of what the outcome will be, and you have those backup plans, then it might make sense to do that. A really quick recap. When I had 7 units or less, $10,000 in reserve was enough. At 14 units, while I'm working, I'm keeping $30,000 in reserves. When I'm purchasing a rental property, I factor in 10% for repairs, maintenance, and capex, and 5% for vacancy. I don't factor in property management yet because I'm self-managing and I expect my income to grow enough to cover that in the future. If I ever stop working, I'm going to raise the amount I keep in reserves. Do me a favor, in the comments below, let me know, do you make it simple? Do you have a confusing equation? How do you actually factor how much reserves you want to keep? I hope I made it worth your time clicking on this video today. If you thought you got anything out of it, hit like, hit the notification bell, share this with a friend. Until my next video, thanks for coming to my Dion Talk.
We're sorry, the number you have dialed is not in service at this time.